Welcome to the Retirement Daily Learning Center. Today, in part 5 of our Social Security Primer, we will talk about Social Security income taxation. And our speaker is Martha Shedden. Martha is co-founder and president of the National Association of Registered Social Security Analysts. So welcome to the Retirement Daily Learning Center, Martha.
Thank you, Bob. Thanks for having me again. Welcome everyone to the 5th in this series of Social Security webinars. I'm excited to be presenting for you again today. And this week we will be discussing taxation of Social Security income. So somewhat of an obscure topic. Many of you may not realize that your Social Security income can be taxed. And that's why we're going to review this topic today, because you're probably wondering, why didn't I know about this? And the fact is that the taxing of Social Security income can be overlooked because we're not faced with it until we retire and start collecting Social Security. And the way that it is calculated depends on our income in retirement. So if we don't know about it, retirees can't see it or plan for it. So it's sometimes referred to as a stealth tax because it comes in under the radar. This isn't to imply that there's a special Social Security income tax secret hidden tax code. Retirees, though, should be aware and informed about how this works, since it can sneak up on you and without any warning. So we're going to have our true-false quiz again today. And here are the statements that we'll look at the end of the presentation. True or false, Social Security income is taxed like other income. High-income retirees will have 85% of their Social Security taxed. Income from Social Security taxation is deposited in the general fund. There may be ways you can manage this taxation. And today, twice as many people are subject to this tax as were in 1983. The presentation overview, we're going to talk about when taxation began, how much it is taxed, and how the tax is calculated, and who is most affected by this tax. Also, we'll review possible ways to manage taxation in retirement. And I'm going to go over the states that tax Social Security. So there's a few of those. And then a case example at the end will hopefully illustrate how this all works. So when Social Security began, the US Treasury ruled that the benefit payments would not be subject to taxation in 1935. But fast forward to 1979 and 1983, the Advisory Council on Social Security and the National Commission on Social Security Reform both recommended that some Social Security benefits be included in federal taxable income. The changes included up to 50% of Social Security benefits as taxable income in the 1983 Social Security amendments. This became effective in 1984. And at that time, there were thresholds set up for taxpayers whose combined income, and I will describe that to you on the next slide, if that is exceeding a certain threshold for singles and for married, then taxpayers might pay taxes on it. There was another set of calculations we'll look at after that. Also included in the 1983 amendments was the stipulation that income from taxation of Social Security benefits was to be deposited back into the Social Security trust funds. So it doesn't go into the federal general fund. A decade later, legislation enacted in 1993 extended the taxation of these benefits, and it allowed for up to 85% of taxpayers with combined income over certain thresholds, and we'll see those thresholds in a minute. The additional tax from this 1993-94 legislation is deposited into the Medicare Hospital Insurance Trust Fund. So here is the simple calculation for what combined income is. And you'll note here, well, first of all, 100% of gross income is included. Only 50% of our Social Security income is counted in this equation to determine if it's taxed. So it's given a tax preference. And the reason that it's only half, well, part of the reason, you know, we all pay into FICA, the 6.2%, employers and employees. Now, the employers get a write-off for what they are paying in. So really, we are, as employees, depositing, contributing half of the amount. So it was discussions like that that led to this decision of the different ways that this is all calculated. But what you should know that it is given a tax preference. Only half of it is used in the calculation. And then tax exempt interest is added to that as well. So this what adds up to your combined income. The combined incomes have not changed since 1983 and 1994 when they were enacted. And you can see those here on the chart. This shows combined income on the y-axis for married and single tax filers. For married couples, if their combined income is less than $32,000, then their Social Security will not be taxed. If you're married and you have a combined income between $32,000 and $44,000, up to 55% may be taxed, and over $44,000, up to 85% can be taxed. Same thing for singles under $25,000, not going to be taxed. Between $25,000 and $34,000, up to 50% taxed, and above $34,000, possibly up to 85%. But this is all that may be taxed, not what is taxed. And I will get to that explanation in a minute. I wanted to show you this worksheet because this is what tax professionals and accountants use to calculate the amount of our Social Security that will be taxed. And then that goes to a different form, of course, and that's counted in the taxation of the income. And it's so confusing. I just wanted to show it because it sure doesn't make sense to me. I'm going to show you a much simpler explanation of the three equations. There's actually a three-part test going on here, but it's really hard to determine what that is. And I also want to you to be aware that we should all be considering taxation, Social Security taxation, within the bigger picture of retirement finances. Because when we reach 72, our retirement accounts, IRAs, 401ks, 403bs, have required minimum distributions. And those distributions are 100% taxable. So they're in that gross income amount on the combined income formula. This causes adjusted gross income to go up and possibly makes Social Security more taxable. Social Security is not 100% taxable. So when you're talking about which funds to use in which order and what amounts as you're moving into retirement, there can be tax consequences in good and bad ways when you calculate these sequence of withdrawals and which funds to use first. It's also a strategy for maximizing Social Security income and minimizing taxation, because if you use some of those retirement account funds that are fully taxable prior to starting Social Security, you're essentially trading 100% taxable for less taxable income by having that Social Security. Many accountants and tax professionals may not ask their clients prior to the RMD age of 72 about their retirement account balances, since they're not usually generating any revenue. But both accountants and tax professionals and financial advisors as well may be missing out on a valuable forecasting opportunity to help their clients. And you, as their clients, have the information now to ask them about this. So this is the simplified version of the worksheet that we just saw. The three-part test is used to determine exactly how much will be taxed. And it's, of course, another complicated math process. I don't want you to be caught up in too much in the math here, but I do want to show you the process, and then we're going to look at a case example to look at the numbers and make it more real. So the first part is calculating 85% of the Social Security benefits. The second test is to calculate 50% of Social Security benefits and add 85% of the amount of combined income over the second threshold, whether that's single or married. And finally, the third test is to use 50% of combined income over the first threshold and 35% combined income over the second threshold. And believe me, this will be more clear when I show you the numbers. So here's an example, and this is a couple case. In this case, the couple has an adjusted gross income of $36,000. Their Social Security benefits are $40,000. So their annual income is $76,000. From that, we can calculate their combined income, which is the AGI, $36,000, plus half of their Social Security. So their combined income is $56,000. Now we'll go through the three-part test. You can see that 85% of their Social Security benefits, $40,000, gives us $34,000. That's the first result. The second part of the test, using half of the Social Security and 85% of the amount, the combined income over that second threshold. So they have 56 in combined income, and the married second threshold is 44. That's $12,000 multiplied by 85%. So the second part adds up to $30,200 will be taxed. Now, when you see the third part is 50% of combined income over the first threshold, and that would be 56,000 minus 32, which is 24,000. That gives us 12,000. And then 35% of the amount over the second threshold. Again, that's the 12,000. So that gives us 4,200. So for this couple, their taxable Social Security is the lower of these, which is 16,200. Now you'd think with their combined income of 56,000, they're up there over the second threshold, that they're subject to 85% being taxed, but in reality, only about 40.5% of their Social Security is taxed. This is all done automatically, and some tax professionals are not even really aware, I think, of all the details that are going on that worksheet. It's all just automatic, but let's talk about the bigger picture here. So many people will not be paying any taxes. Let me go back a slide here. So many people who are married with a combined income of less than 32,000, they will not have their Social Security tax, or single less than 25,000. And then on the other extreme, very high net worth, high income folks will have 85% of their Social Security tax, and there's not much they can do about that. And in fact, most financial planning software considers that all of our Social Security is 85% of all of our Social Security is taxed, and that's not true. So it's that middle mass affluent middle group of taxpayers that might have the ability to manage this by considering all other income, other income streams in retirement, the amounts of withdrawals, and the sequence of those from those other accounts. And that's something that a financial planner can help you with. Now, this next slide shows over the course of time, the two thresholds that were set up in 1983 and 94 have not changed. So they have not been adjusted over the past 40 years for inflation, which much of Social Security's numbers are adjusted for inflation every year. And today, 5 times more people are subject to Social Security taxation than in 1983. You can see why, because if we use the National Average Wage Index as a very rough estimate or comparison to income in general, in retirement, because as the National Average Wage Index has gone up, those amounts that we have as income in retirement have gone up over the years as well. You can see back in 1983 that when it was up to 50% could be taxed, it affected only those, it didn't affect many people at all, because the average wage, National Average Wage Index was only 15,000. So having income in retirement way over 15,000 was more rare. So that's the point of this as we move on, and those thresholds have not changed. And this is just for a single person. More and more people are subject to it. And today it is about 50% pay taxes on their Social Security. The good thing, like I said, though, is that income does go back into the trust fund. It's helping to fund benefit payments. But it has really gotten out of relationship with what has gone on with inflation over the years. So that's what that shows you. And now I want to go through a case study, and I've simplified this. It's very simplified. But what we're going to do is look at the case of Ted and Alice. They have Ted has a primary insurance amount of $2,200. His life expectancy is 90. Alice has a primary insurance amount of $1,200, and her life expectancy is 90. They would like to have an $80,000 annual spending goal before taxes in retirement. So what we're going to look at here is what if they both claim their Social Security at 62 versus 70? And I'll talk about how that all comes together with this taxation. First, we're going to look at their annual income. First, we're going to look at if they claim at 62. They have an annual income of Social Security, which is lower because they both started collecting before their full retirement ages, and their Social Security calculates out to be $28,560. So if they want to have $80,000 in the spending goal, they would need another $51,440 of other income, and that would be 100% taxable. So if we add that up, their combined income is for half of their Social Security, $14,280, and all of their other income. So the taxable income, which isn't shown calculated here, but it does end up being 85%. So $24,276 of their Social Security is taxed. And then the other income that they're receiving from other funds will be 100% taxable. Their total taxable income then is $75,716. Now, if they both wait to claim till 70, they're going to be using other income from from their retirement accounts, from other investments. They're going to be using that for 8 years between 62 and 70. And that we're going to assume is 100% taxable. Once they reach age 70, they will start collecting Social Security. Their Social Security is going to be significantly higher because they waited until age 70 to collect it. And that adds up to $50,592 of Social Security. Now they only need another $29,408 to meet that spending goal. And their combined income is $54,704. So the first 8 years of retirement, they're going to pay at their marginal tax bracket. This is all the income taxes, your marginal tax bracket. They'll pay 100% on $80,000. They'll pay the marginal tax on that. But that's from 62 to 70. Oh, and I see a typo on here. Their taxable income, however, from 70 and up is going to be only $15,098 of their Social Security. And that was the 3-part test was run on that amount. And that's what it came up to. And therefore they'll only need to use $29,408 for for the other income they need. So their total taxable income by claiming at 70 in this hypothetical, very simplified case is $44,506. And there's several graphs I have here showing how this all works. If they start collecting at 62, their cumulative income will add up to about $828,000 over their lifetime. And if they start collecting at 70 and live to 90, they would collect over $1,062,000. Their taxes, as you can see here, based on what we just looked at, their cumulative total taxable income, if they start collecting at 62, will be over $2,195,000. Their cumulative total taxable income, if they wait to collect till 70, would be $1,574,000. So significantly less. The other income needed, which is a kind of a backwards way of a case example, but they would only need, if they started at 62, they would need over 1.49 million. And if they started at 70, they could have, they would need 1.257 million. So less other income needed to meet their spending goals. And here we see the amount of taxable Social Security. If they claim at 62, 85% is taxable, 15 not taxable. And if they claim at 70, 30% of it is taxable. Their annual Social Security is significantly different between claiming at 62 and 70, but that increase in income that's not 100% taxable is the reason that this works out this way. So if anyone has questions on this, I know it's a confusing topic. feel free to reach out to me. But the last slide here I have is just to let you know that there are some, besides federal taxation on Social Security, there are some states that also tax on Social Security. And those are, you can see the 12 states here on the slide. The policies on how state taxes are calculated vary. Some of them do follow the same federal rules. Some of them offer deductions and exemptions based on age or income. Some of the states are in the process of reducing or eliminating taxation, and West Virginia in particular is, it's not shown on here because they eliminated their taxes this year. So there's just 12 states that do that. So that wraps things up, and we're to our true and false quiz. You should know by now that Social Security is not taxed like other income. We saw only up to 85% is taxable, and sometimes much less. High income retirees will have 85% of their taxes, Social Security taxed, and this is basically true. Once you get past a certain point in those equations, we saw 85% of Social Security is taxed. Income from Social Security taxation is deposited in the general fund. That's not true. We saw that. That's another myth that people have about Social Security, but it does go back into the Social Security Trust Fund. And there may be ways to manage this taxation. This is true, especially in the mass affluent group of retirees that are not neither very, very wealthy or very, very low income. And today, twice as many people are subject to this tax as in 1983, and this is false. It is 5 times as many are now subject to this taxation. So that wraps up my presentation for today. Thanks again for watching, and always feel free to reach out to me if you have questions. The best ways to reach me is at my email, martha@narsa.org. Thank you.
Martha, that was a great presentation as per usual. Just a couple questions. You mentioned, I think, that roughly 50% of folks who are receiving Social Security benefits are paying a tax of some sort. It strikes me that given how, and it strikes me that given that you have to use the worksheet to figure out whether this income is taxable, are people prone to make mistakes on it? And is it possible that more people are paying tax than should be, or maybe more people should be paying tax that aren't?
You know, I don't think so, Bob. If you look in detail at that worksheet that the tax preparers fill out, I mean, it's very precise, you know, like all tax forms. Take this line, multiply by this line. So I don't think that's a big part of it. To me, it makes sense that 5 times more people are taxed because of inflation. So,
right.
And that is one of the suggestions in the 2100 Social Security Act, a sacred trust, is to start adjusting that somewhat for inflation. Right.
So for someone who might be receiving Social Security benefits for the first time, would your advice be to use a CPA or a qualified accountant who is familiar with how Social Security benefits are being taxed and the worksheet?
I would recommend that, and I would recommend that people. Well, that's why I presented this, because it's so hidden, and there's strategies you can use early on, as with this case, before you're even 62, to say, okay, let me use some of my IRA money, and I'm going to draw down those RMDs. So when I get to 72, first of all, if I can wait to collect Social Security, I'm going to have a much bigger check, and much less of that may be taxed. And then the RMDs are going to be lower because you use the money. So it's something that should be looked at early on.
Right. And of course, there are some other tools besides drawing down your RMDs. You could create a bridge annuity. You could, well, there are other tactics. You could use a reverse mortgage or your life insurance, right? For instance, there are other tactics to use your Roth IRA.
Exactly. Oh, yeah. Roth conversions. I didn't even mention that. If you have high regular IRAs and you have lower taxes while you're waiting to collect Social Security, perhaps convert those to Roth. So it takes a well-informed financial or tax professional to help you with that. It's a very holistic view of the whole picture.
Mm.
But it's complicated. It's hard to explain, but I try.
Yeah, no, you did a great job. So I'm going to throw you another curveball, if you don't mind. As I was thinking about it, there may be plenty of cases where one spouse is claiming Social Security, the other isn't. They're filing, they're married filing jointly. Would there be an advantage to married filing separately in some cases if one is getting Social Security and one spouse isn't?
Oh boy, that's a load. Yeah, that's a curveball. All right, but I know generally that married couples are better off filing jointly.
Yeah.
So I would say probably not. Might not be worth all that, but good question, Bob.
I was trained to ask good questions, and anyway, it's certainly easier when you think about doing it married filing jointly or filing single if you happen to be a single taxpayer. But it's that gray area in between whether it makes sense or not to crunch the numbers and see if it's worth doing or not.
I think it would be a good case study.
All right, maybe for our next webinar. And I think I'm plumb out of questions, but I know for our next webinar we have a surprise, and so we're going to work on what that content will be.
We will, yes, we will. We will try to have a wonderful finale.
All right, Martha, this has been great. As usual, we can't thank you enough for sharing your knowledge and wisdom with our viewers and our readers. It's greatly appreciated.
Thank you, Bob.